Everyone, thank you for being on, and we appreciate you being on time. And we're so excited about this topic. It's interesting as we continue to answer hotline questions every day, how much emphasis people are putting on taxes right now. These, the proposed tax laws before Congress are really stirring people up, and getting people either excited or depressed or at least interested in taxes. I don't know which one's better. So we're
Yeah.
we really appreciate Joel being here, especially right in the middle of his tax season. Thank you for being here. And so
Sure.
before we turn time over to him, just a couple housekeeping things. If you're brand new to us, this is an ongoing webinar series. It's been going on for it's got to be 12, 15 years. I don't know, whenever webinars were created. And most of these now are recorded on YouTube. And so if you happen to miss one, want to go back, they're generally available on YouTube. And so if you'd like to subscribe to that, you'd go to YouTube and you punch up Protect Wealth Academy and simply hit subscribe. And if you'll do that, then you'll have access to everything that we've done in the past. I'm not sure that you want everything that we've ever done, but there's some really good stuff in there. Okay, the upcoming summits. We finished a live event in Orlando. We had some amazing students there. It was a really fun event to actually see people live in person and get to, just see their eyes as they it's hard as teachers to sit and talk to a computer screen, and this was a fun class. So next week we've got a live stream event. We're bringing all the incredible speakers: Scott Estel, former senior trial attorney from the IRS, Mike and Stacy Koval, Clint Coons. We're bringing Kwame Granderson. Gene Garino won't be with us this time. He's ill right now. Bill Danko, co-author of The Millionaire Next Door. We're bringing, oh my gosh, just incredible people. And so if you haven't had a chance to sign up for that, you haven't attended one, there's two coming up before the end of the year. One is live. That's in Vegas. That's at Green Valley Ranch Resort. It's a 5-star, 5-diamond luxury hotel. We got a great price as a group rate. So you can either attend live or live stream. But the live event will not be recorded. We are not going to do both. You really have two options. You can attend live stream next week, Monday, Tuesday, Wednesday, or the live event in Las Vegas. Either way, we need you to register for those. And especially if you're going to do next week, it'd be a good time to do it now, so that we know you're coming. We do have a limit on our Zoom account, and we certainly have a limit on how many people live we can have. If you'd like a copy of the agenda, that didn't really work out well. The live stream summit, anyway. Look, you can download that at protectwealth.com. We have posted the one for the live stream event. We have not posted the one for Las Vegas yet. We're still working out the speakers and the times and their travel schedules and everything else. But the content will be fairly similar, although by the time we get to the live event, maybe Congress will have figured out some of these tax laws and come a little closer to where they need to be. Anyway, there's that. And then before we ever talk taxes, there is always going to be a disclaimer. Joel knows this as well as I do. The strategies that we teach may or may not apply to you but we will teach good, simple strategies. We will be accurate in what we teach. It's just the application. This is a time that we encourage you to talk to a tax professional before you implement any of the strategies that we teach. We cannot give legal and tax advice here. We can only teach strategies and hope that that you can apply those to your situation. And at the end of this, we'll give you an opportunity to sit down with the professional from Tax Hive and go over all of these strategies with them and see if this applies. So with that, Joel, they didn't come to listen to me, they came to listen to you. And so let's open this up. You can pull your screen, share your screen if you'd like, and let's get into taxes. There's so much opportunity right now. I don't know that there's ever been the need for tax planning like there is right now. Would you kind of agree with that, with so much on the table?
Yeah, I would. It's interesting. Hey, let me just say one thing though before we get into this. I'm just going to throw my hat into your events that you're having. I've done a number of them at Green Valley. It's an amazing place, fantastic place for an event. So I would encourage everyone who has the opportunity to go down there and participate with that. And that with you guys would be a really fantastic weekend, I think.
Thank you.
Sure.
Appreciate that.
Now we can talk about tax.
Oh, we're excited. Okay.
Yeah, I mean, tax. Sometimes I hear that the IRS is your single biggest debtor that you'll have in your entire life. I don't know whether that's exactly true or not, but let's just say it's the debtor that never leaves, right? And it's the one we always have to deal with, unfortunately, year over year. And the better we plan for these types of situations, the better off we're going to be, especially on the tax planning end of things, to basically, well, essentially do what we all want to do, and that is keep more money in our pockets. I'm going to skip this, which we've already kind of gone over. Now, I like to kind of start these things with a couple items that are currently happening, or that I'm seeing happening with not only my clients, but when I'm going online and looking at the various forums and the various informational databases that I go to get information. And I'm sure this is familiar with you by now, but you may have noticed that you've either been getting deposits in your bank account or checks from the IRS that you've been receiving every month. We're about 10 days away from our next one. And that is the child tax credit that's been paid out early, starting in July, and will run through December 15th, right? So basically six payments. And what they've done is they have basically they're looking at paying out about half of that money early throughout the year, so you have it. Now, there's a couple things you need to be aware of, and I've been asked this question a couple times, is that money taxable? Is the money I'm getting from the IRS taxable? That either is going my bank account or if I'm getting a check? And the answer to that is no. This is not taxable income. It is the prepayment of a tax credit that if you have dependents or kids, essentially, that you would see possibly flow through on your personal tax return. And then the next question I would get, that's kind of a follow-up question to that, is, well, do I have to pay it back? The answer to that's much, much more complicated because it's a tax credit. So will you have to pay it back? Possibly, maybe, not sure, until we actually do your tax return. So here's the one thing you need to be aware of. Usually, unlike the tax returns I'm doing right now, people with children, I guess I would say, rely or expect to get tax credits for their kids. In the past, it's been, $2,000. It's been raised for 2021, as you can see in that comment below. But they're expecting to see that tax credit come and pay for part of their income tax at the end of the year. I have lots of clients with multiple kids, 3, 4, 5 kids, and maybe they're looking at $8,000 to $10,000 worth of credits to rely on paying their taxes at the end of the year or getting money back in the form of a refund. The issue with this is now you're getting it throughout the end of the year. So you don't have all those tax credits when you file for your 2021 tax return, which means your refund may be smaller, which means you may actually owe money back if these credits is what kind of pushed you over the edge into a refund position. So it may actually dramatically alter your tax return for 2021. Now, you do have the option to go out and simply stop them from paying you now and rather take all that credit as part of your tax return for 2021. You would go to the IRS website. You can kind of follow some directions there where you can opt out. Now, I will say you have to opt out by the 5th of the month, not to receive the check on the 15th of that month. So basically today is the last day to do it for October. Otherwise, you have to wait till the check, to opt out for November, and then we're dealing with just 2 more checks. So just be aware that it's out there. It can affect you, and take that into consideration when it comes to your personal tax planning for 2021. Now, I want to also begin this with not letting you business owners make probably one of the biggest mistakes that you can make with your personal business. And that is thinking that someone else, and that would include me, okay, I'm going to include myself in that category, should understand your business or be more vested in your business other than you. And what I mean by that is I see a lot of tax returns. Okay, I'm still in the kind of the like hyperactivity of 2020 tax returns, and I will be for another 10 days or so. And when people just send me information and all they're really sending me is, hey, look at this, here's a credit card statement, and here's a bank statement, this is kind of what was going on within my business, I always ask myself, how vested are you in your business? Because right now you're requiring me to be more vested than you. And if you're not vested in your business, then I don't know how vested I should be. So when it comes to your particular business and what you're doing within your operations, you need to think about the numbers that are flowing through it. I love numbers. That's probably why I'm an accountant, because I love the story of numbers and the story that it tells me. And I'm always looking for, how did you receive money? Your expenses are going to kind of detail what you did with that money when you had it, and what the decisions did you make from an operational standpoint, and then where did that money go? It's the story of money as it flows in and out of your business. And that's why it really intrigues me when someone gives me financial statements and I can go through it with them and talk to them about it and all the details within it, because it creates this kind of wonderful story about how you operated and led your particular business. Because no one else is going to be there in your business every day like you are going to be. So we need to simply be vested in what it is that we do. So in order not to make that mistake, I want to present to you a couple solutions that I think are important for you and your particular business. So not that I want to make you accountants, but there is a certain amount of requirements when it comes to a business and financial records that we all have, and we all fall underneath that same umbrella. So we got to make sure we're reviewing our bank statements every month, and that we understand where money is coming in, and that we have appropriately accounted for the income. So that means we got to be kind of proactive in this game. We can't get too far behind, because let's be honest, I'm like, looking, reviewing, doing all these tax returns. You honestly think I can't remember what I did 2 weeks ago. My wife will ask me questions about, hey, I asked you to do something for me 2 days ago. Have you done it? And I'm all, what, you asked me what? I just can't remember, right? So let alone going back 6 months from now and trying to detail out how you spent money, where you were, what this meant within your credit card just becomes too difficult. Okay. I would also be looking at how long does it take for me to collect money on services or goods that I provide? And then how long does it take for that money to leave for me to pay for my particular expenses? And then I would also kind of surround myself with professionals in various areas that I may not want to be as proficient in. Not that I'm not proficient, but may not want to be as proficient as they are, that spend all their time doing something to help me kind of round out and take up some of the space that I don't want to deal with, that allows me to really focus in on what it is that I want to do. And I always like to give personal examples, because and you'll see throughout this, the short time that I have you with me, you'll get to know me a little bit. So if I'm not here in my office and I'm doing and working with all these numbers, and welcome to my office, by the way, certain things that I do to relax is I like to cook. And I like to research knives and buy just the right knife for just what it is that I want to do, and the right pan for this particular item, or sous vide machine for this particular item. So I'm really into cooking. And so when I think about my own particular business, I think about the difference between a chef and the restaurant owner. Okay, the chef probably is more concerned about the environment that's in the restaurant, what the specials are, what the menu is detailing, depending on the time of year, the interaction with his, kitchen staff, his reputation or her reputation, depending on what it is that they do. So really, they're simply focused in on what it is that they do. Whereas the business owner, and hopefully, this will kind of speak to you, is more broadly concerned about everything else. This is what I call about being vested in what it is that you do. So they are concerned with the rent and how much money they're making and their gross margin and how much their bottom margin is. And where can I get the best ingredients at the best price? What is my cash flow? Do I want to expand? Do I want to stay here? What is my lease arrangements? You can see that it envelops a much, much broader area when it comes to us and our business than simply being a chef. So as we go through this presentation, think of yourself as the restaurant owner, not simply the chef that only can kind of look at a very small segment within the grand business of owning a restaurant. So let's look at this wonderful display of tax rates. Now, I know you're looking at it and you're probably thinking, yeah, it's boring. I don't care. But I'm going to change your mindset a little bit because I want you to think about how much money you're actually making from a business transaction and how much does it actually cost you when you spend money for items for your business. Okay, what is it that I'm making and what is it that I am spending? Because really, when understanding where you may fall on this particular chart, for example, has a very large impact on the money that you make and the money that you spend. And I want to go through two examples, one on each side, of kind of how that mindset should shift, understanding where you fall within this particular category. Am I in the 32% rate, 10% rate, 37% rate? So it may change how you spend or how you look at money that you get. So let's say, you see that beautiful car right there? Love cars. Cooking in cars, it's my thing, right? So let's just say, for example, that this wonderful Ferrari that is sitting down there, that for whatever reason, you had the opportunity to buy this at a significant discount. Let's say it cost you $200,000. Now, I know that the value of this car is actually $300,000. So I'm going to buy it, borrow the money, do what I have to do, because I think I can turn it for a quick profit and make $100,000. So I get it, buy it, sell it, and I get $100,000. So my question, or my follow-up question to you after that slide, is that what you really made? Was $100,000? Is that the money you had to go spend on vacations and snowmobiles and, I don't know, e-bikes and whatever it is that you're into? Is that the money you have to go spend? Or is that wonderful partner that you have in everything that you do, the beautiful IRS, and I say that somewhat sarcastically because it is October 5th, are they owed anything from that $100,000? So the way I would view it is, okay, I made $100,000, but what is my effective tax rate? If you go back to that chart and you look at your tax rates, what's your tax rate? Because that is what is owed to your wonderful partner, the IRS. So let's say I have an effective or blended tax rate based on all my income of 20%. I owe $20,000 to the IRS. I made $80,000, and that's how I should view it. I should always be aware of what is my tax or possible tax amount owed when I'm bringing in money, so I can either set it aside, make an estimated payment, or reinvest it into the business and spend it, right? Creating deductions, but I have to be aware of what I could possibly owe, because getting behind with that wonderful partner can be a very, very long and difficult road to catch yourself back up. Now let's look at the other side, the spending side of things. So I like Apple products. I use them. I have an iPhone, so it's right there. I have an iPad. I do not use a Mac, however, because my software doesn't allow me to. But let's say I went in and looked at an Apple iPad, new one, iPad Pro, current generation. And about $1,600. That's a fair chunk of change for a kind of a tablet, right? It's on probably the higher end that I can think of from a tablet perspective. I had a little bit of Apple Care. I'm almost at $1,800 for that particular item. Now, problem with Apple, I think about it, is that they rarely put their things on sale. It's a beautiful global marketing strategy that that typically that only older equipment or out of date equipment, if you're thinking about the latest gen stuff that's out there, that stuff goes on sale, right? And not even that great of sales, to be honest. But let's say that since it's new, Apple's not putting on sale. I go to Best Buy, I go to Amazon, I go to the Apple Store. It's all going to be the same price, right? Now I'm buying this iPad for my business. Why? Because I'm going to use it in my business. I'm going to take notes on it when I go to meetings. I'm going to do all my emails at night on my iPad. I'm going to have certain PDFs and certain, research tools on that iPad that will allow me to try to be a better CPA. So I look at it and I say, okay, Apple doesn't put that on sale, but since I'm deducting it inside my business, that partner that takes money, the IRS, when you buy something and deduct it for your business, is now contributing to the cost of that in terms of my effective tax rate, that 20%. So while Apple doesn't put it on sale, the IRS puts it on sale for me and I save $350. And I got to put that right back in my pocket. Okay, so that's the power of knowing where you are from a tax rate perspective, understanding what it is that I may owe from it coming in, or realizing realistically, if I'm buying something for my business, everything's on sale because I get to deduct it and save tax dollars in the form of reducing my taxable income. So how do you think the IRS views these tax changes? And this is a big one because we're coming up on some, I'm going to say possible, more likely probable tax changes that are going to be here. They're talking about them. I see them. I read them. I know they're coming. Do I know exactly what they're going to be? No, but I may have a fair idea of what I think they're going to be based on kind of current, the current establishment. But let me take you back a couple of years to when the current tax code was passed and put into place. So if you remember, we have this $10,000 deduction that's currently in place. So really, it's unfortunate because it kind of hits those, for the most part, kind of the coastal states, I would say, the hardest. Because if you're on the coast, typically maybe your state tax rates tend to be a little higher. California, New Jersey, your property taxes tend to be a little higher. So that $10,000 can get maxed out really, really quick. I remember I was it was December, I was in California for the holidays, and a tax client got a hold of me and said, Joel, I have this beautiful idea. I'm going to prepay all of my property taxes in 2017 because I know that, or at least I'm guessing, that in 2018, I'm going to shoot past that $10,000 limit. I'm going to lose a lot of deductions. So if I prepay it in 2017, I'm going to take the full deduction that year because I'm not going to be able to take it in 2018. And we had a conversation about this. He may say we had an argument about this, but in the end, I kind of convinced him not to do it, much to his complaining, I'd say, but he didn't do it. And then lo and behold, about 2 weeks later, I think it's mostly because it was in the news and the IRS looked at that specific issue and then sent out a bulletin where it basically stated that unless the property tax has been assessed, and that's the word that they used, and just know the IRS loves to use words kind of to their advantage. So unless the property tax has been assessed, you cannot deduct it on your tax return. So all these prepayments that have happened can create what I call dead money, because when is property taxes typically assessed? Like I live in Utah, we assess it in the year we pay it. I know California is a split year, but typically most states operate under that parameter. You assess property tax in the year you pay the property tax. So that means had he paid it in 17, he could not deduct it in 17, right? Because those property taxes were not assessed. Come to 18, I can't include it in 18 because we're all cash-based taxpayer because it was paid in 17. So that creates a bunch of dead tax money. I hate dead tax money. But it's the way the IRS views these tax changes. And sometimes we don't always know up front exactly how they're going to interpret things, like with the PPP loan. Like we all went through that. Really, in the first, the IRS said, nope, you're including it in income. And then they came back later and then agreed with Congress, said, okay, fine, you don't have to include it in income, but you're not getting the expenses. Then they came back again and said, okay, fine, you can take the expenses, right? So it's this big like interpretation issue with the IRS. We always have to be aware of that, especially when we're approaching more than likely that we're going to have some tax changes. So look out for kind of the IRS determination on how we see these things, because that basically tells me how I want to interpret these and lead my clients to certain maybe ways of operating their business from a tax perspective. One of the items that is still in place, and from what I'm looking or hearing and reading, is that this will most likely carry over, cross our fingers, because this is a great deduction. The qualified business income deduction, or the QBID, allows us to take a 20% deduction from the income I make when I'm self-employed, or the pass-through from an LLC, for example, or certain deductions from S corps based on wages and other assets that we can obtain. But in general, you have to think of the QBID, and we always like to use acronyms, it helps, as a 20% reduction that I don't have to do anything for on my tax return. Now, it is a weird deduction in that it qualifies in your business return, but it's actually taken in your personal return. And there's always these little connections that have to be made when we're transferring information from one return to another. But essentially, you can see this example. So revenue of 150,000. Let's put myself in here. So let's say for my CPA business, over the course of the year, my clients paid me $150,000 to provide my service. In order for me to provide those services, it cost me $50,000, leaving $100,000 worth of income. The QBID simply comes in and says, boom, Joel, you get a $20,000 deduction, and I'm only going to charge you income tax on $80,000. Love it. It's fantastic, right? Fantastic. Now, the issue, again, interpretation and kind of how the IRS likes to use words as they move forward, is the QBID qualifies for what we say active income. And really that active income means, is there a Social Security or self-employment tax associated with it? That's why when I said S corps, we're dealing with different factors in order to qualify for this particular deduction, because that S corp income comes to us passively. So just be aware, it's active income. And for you rental real estate people out there, you can qualify for the QBID even though your rental real estate is passive. And if you want to know how to do that, sit down with your tax provider, go over it and say, hey, do I qualify for the QBID with my rental activity? And there are hours and other indicators that you need to meet in order to do it. But again, don't ever give up on a 20% deduction that's freely given to all of us simply based on us making money. It's a great, great deduction. Let's talk about home office. Why? Because I don't think you're taking it. Why do I say that? You know, I do a lot of tax returns. I even went to the IRS's website, and I love, well, this going to tell you how great my weekends are. I look up Irs Stats. What do you think about that? And my wife's a CPA, so we can enjoy it together. Yeah, family parties are amazing at my house. But nonetheless, right, when I looked at these statistics, it said that something like it was less than 20% of businesses were taking the home office deduction. And our landscape has had a serious change from a self-employment standpoint due to the current pandemic that's occurring. A lot of us have moved from offices to our home and doing business from our house. One, you know, it's pandemic related, but two, because businesses and clients are now more accepting of these types of situations. And I think honestly, it's going to continue for, even if the pandemic ended tomorrow. I think this, the home office and where you work and the kind of global aspect of things isn't going to change, but allows me to live in Utah and have clients in Florida. Okay. But most people don't take it. I think it's because they make them nervous about the home office deduction. Yes, we have to have it exclusive and regular from a business standpoint, but a lot of us, because of what's happened with COVID, have that scenario, and we have to then re-examine whether or not we're actually taking home office deduction. I'll just briefly go through these two scenarios of how you can take it. Traditional home office really looks at the cost of your house in total. Okay, it looks at your home mortgage interest, real estate, insurance, repairs, utilities, and then it assigns a percentage based on the size of your home office in proportion to your total home. And then you get a deduction for it. For example, let's say I lived in Newport, California. I spent $1 million on a 1,000 square foot property. I say that just because I love Newport, right? That's 10%. So then I look at my home mortgage, interest, taxes, all those things that I listed, and I basically get 10% of that as a home office deduction. Now, the kicker on the traditional method is that I also need to depreciate the value of what I have converted to business use. So again, $1 million, 1,000 square feet, 10% being 100 grand. I need to depreciate that 100 grand over 27 and a half years, much like I would any other property. So the issue with that is that when I sell that home, and I think, great, hopefully I qualify and get this great $500,000 if I'm married exclusion, I don't have to pay any tax on this gain, that all this depreciation that I've taken in the past now comes back to income, and I owe some tax on it. So that's kind of the back end trap to the traditional home office. Now, the simplified home office came out a few years ago. The IRS made it much easier for us. They simply says listed $5 per square foot up to 300 square feet for $1,500 deduction. Don't worry about home mortgage interest, all those other things, especially if you're itemizing, then you can push them over to your Schedule A deductions, for example. There's no depreciation recapture, simple deduction. I would say if I have a home office, I love the simplified home office method. If I'm a renter or I'm renting my home office, I love the traditional home office method. So really, it's going to depend on your particular circumstance into which one is best, and maybe have that discussion with your particular tax professional, whoever it is that you use. Okay, we're going to circle back to cars again, right? We had that wonderful Ferrari that we bought and sold and made 100 grand off of. And now how about cars that we utilize inside of our business? Now, this is fantastic. I love this one because, well, it just allows me to write off one of my favorite things in the world, which is my car. And it allows me to maybe bump up a trim level, because if I'm writing it off, that means the IRS is contributing to the cost of that car, and maybe I can afford a little something more. So really, there's two ways of writing these off. We have the mileage method and the actual method, and they're very different. And I cannot flip-flop between the two as I move forward. If I select actual for a particular car, I'm stuck with actual forever. Just be aware of that. And they basically operate kind of exactly how they look. So let's say that you drove 10,000 miles for business during a year. You simply do the IRS mileage rate that's given and changed year over year. But let's say it's 56 cents. That's a $5,600 deduction that goes inside my tax return based on the use of that automobile. Now, the actual method's a little more complicated. I got to track gas, insurance, repairs, maintenance, all the carbon fiber bits that I put on my car, my wheels, the Jeep, my 36-inch tires, right? I got to track all that stuff, okay? And then I throw it into a big pool, and then I look at how I use that car. So let's say that I drove 10,000 miles total, 5,000 miles of which were for business. That's a 50% ratio. Then basically I'm taking 50% of those costs as my deduction. And I'm also depreciating kind of 50% of the car as an additional cost to give me my total auto deduction for the year. So the question you should be asking yourself is, which one is better? And typical CPA fashion, I'm going to say it depends. And it does depend. Depends on what kind of car you drive. I mean, cars are getting better and better these days. They're not breaking down as much. They're getting better gas mileage, especially now because of some of the parameters the EPA is putting out there, right? And, I may buy a Prius, a Toyota Prius that gets 50 miles to the gallon, never breaks down, costs me virtually, not a lot of gas. And so the mileage method is going to be better. Or I may go buy that Jeep that I talked about and put these enormous tires on, 6-inch lift. That thing gets about 8 miles to the gallon. So maybe an actual is going to be better just because I'm spending thousands of dollars a year in gas. So it really is going to depend on kind of what you're seeing. I will say this. We'll set up all the tax returns I look at, review, or do. Mileage method is far more common, simply because cars cost less to operate and get better gas mileage. And so just usually there has to be a reason to do actual. That doesn't mean those reasons don't exist, just they're a reason to do actual. Okay, so basically, again, sit down with your provider, ask them which one is best, and then you can kind of evaluate how you want to use your particular car for your particular business. Two quick things. No, your business does not have to own the car in order for you to deduct it. And yes, you do have to track your mileage, which I'm sure all of you already do, right? Okay, just try to get better at it. Okay, but yes, track your mileage, track your mileage, track your mileage. Okay, let's talk about business expense classifications. This wonderful code, section 162. I don't want you to go run out there and read the code. I mean, you don't want to have your weekends like mine, but just be aware that this code dictates ordinary and necessary expenses. So what does that mean? This is kind of the parameter or the all-encompassing kind of concept that allows us in any business really to deduct expenses inside your tax return. Is it considered ordinary and necessary? Now, the issue with this is I'm still looking for a great definition that I can throw out there for you, regardless of what business or where you live or how you conduct your business or how much money you make. And there isn't one. This is what I call the gray matter of the tax code because it's so situationally dependent. What is it that you do? How do you operate? Where do you live? Kind of the parameters of working in LA, for example, may not be the same parameters as living in Bozeman, Montana. And the expenses and how you have to conduct business could be completely different. So what I would say when it comes to your particular business, in order to deduct something, or is it necessary or ordinary in what it is that you do, I would really take a hard look at what it is or what went into your ability to make a dollar. Like, what are all those expenses that circle that dollar? I would look at my bank statements, my debits that went through, the checks that I paid. I would look at my credit card statement on how I conducted my business, what I had to pay in order for me to earn a dollar. Look at my vendors. Do I have employees? I mean, that's really what I look at it. What really went into my ability to make a dollar? And that's probably what is ordinary and necessary for you in your particular situation, right? I have my profit motive. This is how I spent money in order for me to make a dollar. I also have to tell you in regards to this. So I live, not too far from my office here. And I have a wonderful kind of group of neighbors, that surround me and they're awesome. But being a CPA, and socializing within the neighborhood, presents a certain number of never getting away from the office opportunities. And I'm always getting asked constantly, whispers, hey, how do I save money on my taxes, man? I heard so-and-so say that they never pay taxes and, what's going on? So I came up with kind of three ways of kind of global ways, if you will, of reducing your taxes. And that is deferring it, spending it, or connecting it. Kind of as a concept, if you will. If you want to tell someone, hey, how do I reduce my taxes? These are the three things I say: defer it, spend, connect. That's how you do it. What do I talk about when I'm talking about deferring it? That's utilizing retirement plans. So at my age, I set up a self-employed or 401k, for example, solo 401k. I can contribute to that solo 401k if I have enough income, upwards of just over $60,000. That $60,000 comes an immediate expense for my business, thereby saving me tax dollars and then allowing me to put that money in for some future event, when I may need it after I retire, which maybe never. Retirement isn't something I long for. So, but it puts money away for the future, right? And it's an immediate expense, and that is an enormous expense. Especially, you can think about, people making $200,000, $300,000, $400,000 a year. $60,000 deduction is huge, right? And you're paying yourself. I mean, that's the best benefit of all. And it's an immediate return because I don't owe any tax on it when it goes into my retirement plan. So to the extent I can defer money through a various number of retirement plans, I would suggest you sit down with your financial planner to go through the kind of the options that are available to you and look at deferring money, creating immediate tax deductions. Spending it. Yep, spending it. Spending it creates the deductions, immediately reducing the amount of taxable income that I may have. We talked in the beginning about spending money and getting everything at a discount. We look again at how are we within our business, operating our business And when does it make sense to spend money to create deductions to reduce our taxable income? We'll talk a little bit about that in a moment. And finally, connecting it. Let me describe connecting it this way. So I will go on Saturday mornings and I will work out with a friend of mine who's an executive at Adobe. Adobe has this amazing building just kind of west of where I am, overlooks the lake. You can see the mountains. It's really phenomenal. And so he works there, does really well, has a W-2. So let's think about his life for a moment. So what is he going to have, even though he's an employee at Adobe? He's going to have a cell phone. He's going to have internet at his home. He's going to have he's an Adobe guy, computers at his home and computer and electronics, possibly that wonderful iPad that I had mentioned earlier. He's going to have a car, probably do some traveling, has to go eat at some point, some office supplies, but he's going to have a myriad of expenses that aren't necessarily attributed to anything but lifestyle and how he conducts his life. Now let's come back to me and kind of juxtapose those two positions. I too have a car, internet at my house, electronics, supplies. I'm going to go buy that iPad, by the way, after busy season. And then, I travel sometimes for work-related reasons, and I have to, eat meals every day. But to the extent I can connect those things, like a car, for example, to my business and utilize that item within my business, now I get a tax deduction for it. Whereas if I was not self-employed and simply have a W-2, I would not. But that's not to say that one is better than the other. That's simply a strategy for those self-employed people to say you have a lot of stuff you're going to have regardless if you're self-employed or employed by someone else. To the extent you connect it to your business, you could possibly create a deduction for yourself and pay less in tax. Defer, spend, or connect. 3 great ways to do it. Now I'm going to get on my soapbox here for a moment and talk about team stacking, or maximum effort, for a Deadpool reference for y'all, but team stacking your particular business. And I'm going to give you an example, if you'll indulge me for a second, of when I started at Ernst & Young. You may know who Ernst & Young is. It's one of the large accounting services firms in the world. I call them the Final Four. When I was there, they were the Big Six. Anyways, I was there for about 10 years. And it was a great place to work. I'm an alum, love the firm. It was fantastic. Great education while I was getting paid to serve the clients. When I left and came and kind of started the firm, I thought I was, smart enough, from a financial perspective, that thought it would be no problem. I'm also an accountant, which my wife says I'm cheap. I just simply say I'm thrifty and, particular about how I spend money. So when I came here, I saw that, I could go buy a computer at Dell, for example. Let's say it costs $1,000, or, I could do the accounting on it. I could buy it for $700, put all the components together, save $300 and put that $300 right back into my pocket. So, being the accountant that I am, guess which route I chose? Yep. Buy the parts, build it, save the $300. So that's what I did. I built my computer, built other computers within the office, which led me to building my own kind of server, which led me to building my own phone system, kind of connecting all the parts and putting all that together, which led me to thinking I'm so brilliant I can build my own website. I got to tell you, that was a dismal disaster, if I do say so myself. But it led me to doing all these things. So let's say October 5th rolls around. I'm neck deep in tax returns, trying to get all these out for my clients and reviewing others, and someone's computer breaks. Who are they going to call? Yep, they call me. They say, Joel, my computer's not working for whatever issue. Then I got to leave my desk. I got to go down to wherever they are, spend 2 hours because I'm not super proficient at it because I don't do it all the time or every day. Spend 2 hours trying to fix it. Then I get back to my office and then someone else calls me and I could blow half my day doing this other stuff. And if I'm not providing tax returns or doing compliance work or planning or consulting or doing something with my clients, I have no billable hours. So all this time that I'm spending fixing all this stuff is just costing me money over money over money. So when I finally realized that, and this was a number of years back, I said, you know what, I'm done. I'm not gonna do anything that doesn't bring in revenue to the firm, nothing else. So we have computers, get an IT department to deal with it. We have a phone system, I'm not touching it, get someone else to deal with it. Have someone else build a website. I don't care. I'm not dealing with it. Have lawyers deal with all my legal stuff, right? So I team stacked around me to allow myself to focus in on what it is that brought me in revenue, right? What brought me in revenue. So I would simply suggest to you, I mean, that's part of the reason you're right here is because you're starting to team stack if you don't even realize it, right? Where am I getting my information to help me with my business or the startup that it can push me forward? Because I'm going to rely on other professionals to do it. Okay. So I would just simply suggest take a look at your business, see where you can maximize your income. Then by putting some of the things we've talked about today in place from a deduction standpoint, right, to maximize what you're doing on that end, to pay the least amount of what you're supposed to pay from a tax return perspective, right? What allows you to do that? This is just one of many things that can help you out. We give you some audit tips because if we get an audit letter in the firm, it's going to come over to my desk and I'm going to review it and give my opinion on how to handle it. Okay, so let's go through a couple things. First of all, realize that if the IRS thinks you enjoy it, they want to refuse it. This is how it goes. If they think there's an enjoyment factor to it, like cars, for example, they even talk about meals that are too expensive. And then there's an enjoyment factor. Oh, you can't enjoy what you do. No, no, no. It's supposed to be miserable. We're all self-employed. Be miserable, right? It's not really the case, right? A lot of us enjoy what we do and find a lot of enjoyment in operating our businesses. But just be aware of that. That doesn't mean you can't deduct something that's enjoyable. That just simply means you have to have better documentation to support it. The best audit defense you can have is documentation, okay? Keeping records on how you spent your money. The question often then arises, well, is my credit card statement good enough? I mean, credit card statements are beautiful. From an accounting perspective, oh my gosh, are you kidding me? Someone else like lays out the date, where you were when you bought it and how much money you spent and put it in this beautiful little PDF for me to look at. I mean, they're beautiful, right? But from an IRS perspective, is that good enough support? So let's say that I went to Walmart. So I'm going to leave here this presentation. I'm going to go to Walmart. It's on my way home. I'm going to buy something for my business. Let's say it was $500. I'm going to go home and then, put it in its office appropriate location. When I get that credit card statement, I'm kind of going through and doing my accounting. The credit card statement is simply going to say Walmart $500, 10.5, right? But it doesn't tell me what I bought at Walmart. I mean, I could have been in there buying computer monitors and some electronic cords and stuff that I need to hook everything up. Or I could be in there buying bananas, underwear, toys, puzzles, a bike, I mean, who knows what, paint, right? So the IRS doesn't know what you bought. So we still need to keep those wonderful, beautiful little receipts. Now, the problem with those receipts are they fade, right? So what do we do about fading receipts? Well, there's a photocopy or picture of a receipt. Is that the same thing from a documentation standpoint when you present it to the IRS? Yes, it is. So that means we get to utilize apps and technology to our advantage. For example, I have an AMX business card for one of my businesses that I operate. And it has an app. It's called Spend Manager. And a lot of banks and a lot of credit card companies are now doing the same thing. It's not just for Amex. But it has a wonderful spend manager that as soon as I swipe that card, immediately in the app, the expense goes in there. I put the receipt down. I take a picture of it. Amex is wonderful enough to store that for me for 7 years. I take the receipt, I throw it away. I never want to look at it because I don't want to accumulate in this office mounds and mounds of paper, right? I want to use technology to make my life simpler. So do that. Photos, do something, but you have to keep the receipt. You can upload them into your computer, put them in the cloud somewhere, just keep them in case you ever need them. It's your best defense against IRS audits. So technology, again, I just kind of mentioned it. I'm not trying to make you accountants, but you do need to track your information. So if you and I were to sit down and I say, hey, so where's your income levels this year? And you say, I have no idea. It's going to be a short conversation. I don't know how to help you unless you give me something that I can work with, mold, shape, and kind of present back to you. So we want to use software and apps to help us in those scenarios. Excel, QuickBooks, TaxBot's another one, credit card apps. You can go online, Wave, for example. I mean, there's all kinds of technology that will help us track information, keep them into categories, compile income statements, or put together a balance sheet that we need, reconcile our bank accounts. That will help minimize the time that you have to put into keeping your records. It's kind of a necessary evil, right? Kind of like dealing with the IRS, but minimize the time so you can really kind of focus back in on what it is that kind of makes you money. Okay, online resources are also great. Oftentimes, even I get stuck, and I use QuickBooks, for example. A lot of clients of mine use QuickBooks. I've used it for 20 plus years, but even I'll run into stuff and I'm like, how in the world do I do this? I jump on YouTube, and sure enough, someone in the middle of, Iowa one morning just wanted a couple likes for that endorphin rush and put out a YouTube video on doing a particular thing in QuickBooks. I give them a like and I'm all, awesome, thank you. You just saved a mountain of time for me and I can learn how to do it. So use kind of some technology and resource aids that are out there to help you along your business with your particular accounting and your particular operations. All right, it's crunch time. It's fourth quarter, people. Last quarter of the year. So what do we need to be doing right now? It's kind of like a sports event. You look at the fourth quarter, ooh, now it's time to rise. Now it's time to shine. Number one thing, and it all depends on this, is your financial. I keep harping on it. I do. I've actually received, someone sent me their tax information. They called me and said, hey, I'm sending you over my tax information. I said, great. Look forward to getting it. FedEx box arrives, bring it in here. It was literally a FedEx box shoved with receipts. To which I quickly sealed back up and said, return to sender, right? Because I don't know what to do with that. I don't know how you spend your money. So if you can tell me how you spend your money with your financial accounting, keeping it up to date, now we can have a conversation. Now I can partner with you, right? When it comes to your business and trying to help you kind of make decisions from a tax standpoint. Okay, so we need to get that up to date. And then we need to look at our assets, depending on where our income is. Like, how much income do you have? How much available cash do you have? Again, depends on keeping your accounting up to date. And then we have to look at, okay, do I need new computers? Do I need things to do podcasts? Do I need things to communicate with my clients? Do I need a new webcam or a new mic or lights or something that can help me better communicate and better present myself to my clients? If so, now might be a time to invest into those things for the business as you get a deduction for them. Or how about investing in different operational strategies? Again, a lot of this is like spending money, right? Because in order to create a deduction, we need to spend money. Maybe I'm going to invest in some marketing and build a new website, or buy some inventory, which we can deduct now for under 25 million in total. And I don't have to worry about capitalizing a bunch of that stuff. So maybe I make an investment into inventory at the end of this year, and then I can sell through next year, right? Again, to create and reduce the amount of income that I have. Look at those retirement plans. Right now you can, so contribute to a retirement plan up to the date where you file your tax return. So if you extend in 2022, you can still in the summer next year, if you haven't filed your tax return, contribute to your retirement plan for 2021. So just be aware of that, but look at those retirement plans as creating deductions for yourself based on the amount of income that you have, maybe maxing out your HSA if you have one. I know some of these are small, $300, but I look for every penny. All right. You gotta look for every dollar. Taxes are death by 1,000 paper cuts. Usually it's not one huge thing that kills you. So we look at every dollar and how do we patch that stuff up. So if I'm not itemizing my deductions and I use a standard deduction, which a lot of people do now, probably 80+% of people use standard deduction simply because it's so high now, that I can still contribute to $300 to my favorite charity and get a deduction for that $300. Or let's say you want to prepay college tuition for the whole year in 1 year to try to maximize my tax credits for that year, right? So a lot of it is evaluating the money I have on hand, and I call it the fourth quarter of the spending spree. And what do I want to spend that is going to lift up my company, right? Reducing my taxable income and lift up my company to push myself into a better 2022, for example. Okay, so look at your business and maybe ways of spending money. All right, so I'm going to go and give you three short takeaways. I know I've kind of kept you here for a while, but first we need to be aware of our tax environment. Okay, we've talked a little bit about understanding kind of how you evaluate where you are from a rate perspective and earning money and spending money, but be aware of my tax environment. The QBID, for example, that business deduction 20%. I talked about team stacking and having strategic partners to help you maximize your income within your business. And then understanding how these tax rates and how these various kind of tax rules and regulations affect your business, that deals with sitting down with a professional and going over your particular situation. Let's use some common sense. Okay. If you have a neighbor that tells you they have never paid tax in 5 years, but has the latest and greatest in terms of boats, side-by-sides, jet skis, cars, all they do is travel, just be aware of two things. They're either lying or most likely lying on their tax return. Okay, so probably not the best person to get your tax advice from. I would think sit down with whoever does your tax returns, a preparer that's qualified, that maybe has an understanding of your particular area of business. Just go and sit down with them. It's worth $100 if they charge you to sit down with your tax person and go over your particular business, specifically now in the fourth quarter, and understanding and how you may want to spend money and do a little bit of tax planning at the end of the year. And I'm not going to say that all tax preparers aren't created equally. I think that's an unfair statement. But I will say that not all tax people have exposure to the same areas or choose to work within any particular tax position, meaning that some tax preparers just don't like to deal with businesses. They want to deal with individuals and earned income credits and things of that nature. Some just want to deal with real estate and don't want to deal with someone who has a retail operation or is a doctor or a lawyer or a professional service individual. So just, I would say, try to match a background with whatever it is from an operational standpoint that you do. And finally, I will say, if you're going to be in business, man, we got to act like we're in business. It's doing the necessary things that all of us are charged to do in order to operate that business, meaning keeping things up in good standing, filing our tax returns every year, making our estimated payments if we have income, keeping track of how we spend and the money that we're making, all those things we have to do. Because at the end of the day, the requirement does reside on your shoulders. And that's why you create strategic partners and team stack in order for you not to have to carry that whole burden by yourself. Finally, if you would like to talk to us, this is how you can get a hold of us. But mostly I wanted to come on here just to simply give you some tax information that hopefully you can take away and apply it to your business, to speak with someone and go through the various things and ideas and discussion points that we've talked about to hopefully improve your particular tax situation.
Cool. Yeah, Joel, I can't believe how much energy you have at the end of a long tax day.
Hey, I'm going to admit to you, it's caffeine related. I must say that is my food and survival method for the next 10 days. I'm wired, and then I go home and collapse. And I come back and do it the same day, same thing next day.
Whatever it takes.
Whatever it takes.
In tax season. Well, good. Hey, I've got a lot of really good questions. I got 3 questions right up front going, is this all about businesses? And my comment, I think, is most people, if they want to save money on their taxes, isn't having a business the very best way to save money on taxes?
Yeah. So here's the thing. So let's say I don't have a business. Our resources are limited, right? Because a lot of things that we're doing from that standpoint is it's dealing with third-party information. Like if I go and I'm an employee somewhere and they pay me a wage, there's not a lot I can write off against that wage, right? And maybe I have some itemized deductions, for example, and that sort of thing. But I can't go out and buy an iPad and write it off against my W-2 wage, for example. So it's very limiting as to what I can do. Now you can strategize a little bit with, if you have investments about timing to sell and maybe pairing that with losses, or, You can maybe do like a donor advisory fund if I want to really amp up my charitable contributions in one specific year because I made a lot of money and then donated that in subsequent years, that sort of thing. But you're limited in what you can deduct in those particular scenarios. So I always say, hey, start a business, do something. Even though it doesn't have to be huge, doesn't have to take up all your time, but do something to stretch the tax code into your favor.
Even if it's a hobby, but you have the intent to make a profit.
So it's all right. So the difference between a hobby and a business is my intent, right? That's what surrounds around it. So I can have a hobby, I can make 20 grand. And if I had $30,000 worth of expenses under the hobby rules, I can only deduct 20, I can just bring it to zero, right? So I don't owe any tax. What a business allows you to do is go negative with that profit motive, thereby offsetting W-2 income, for example.
But there's so many tax deductions that are available to businesses that aren't available to normal individuals, W-2 employees.
Yeah.
And so my advice to people who have been W-2 employees is let's find something you can do on the side and start capturing some of the deductions you can't get anywhere else. So
yeah, so I have a little bit different perspective when it comes to tax, in that I think the tax code is a giant experiment in human behavior. So I don't view it as just a tax code. I view it as a human behavioral experiment. And what I mean by that is, like, if I want you to hire employees, I'm going to allow you to deduct the cost of that employees. I want you to contribute into your health account. I'm going to allow you an HSA deduction. I want you to contribute to your retirement. I'm going to allow you to deduct that. I want you to buy a home. If you remember back to the home buyer's credit, I'm going to give you credit if you go buy a home. You know, a lot of this stuff is like kind of behavioral, where I want to push you from a tax perspective. So what we have to do as individuals or business owners is look how we can navigate that kind of stream to our favor.
cool. All right. Brian is asking, he says, I have a LLC. He gets a K-1 form provided by the investment group, but they messed it up and they're showing a larger profit to him. That's just not the case. The investment group admitted, and they're going to refile it, but they haven't done it. And he still has to file his personal tax return. How do you get that fixed?
Well, here's this is the unfortunate part of that particular situation, is that the IRS will match those two together on his personal. So they've already received the one. When he files his tax return, they're going to match it. If it doesn't match, then he's going to get one of those nasty letters from the IRS saying, hey, you know, it's not matching. We're going to charge you whatever the difference is. So what I would suggest is, I don't know where that difference is. You know, let's say it's not a huge amount. I would file as was reported. And as soon as I can get that amended K-1, then I would update and send in an amended tax return and get the money back that I overpaid. The other issue you can do is, let's say you owe money, you can still submit it as is and then call the IRS and get on like a 90-day to pay plan to extend the time when you actually have to pay anything, thereby trying to get that amended K-1 in, do your amended tax return, then send that in with the actual payment that you have. So there are ways to try to stretch that, but I would be hounding those individuals a lot to get them to amend that K-1.
Yeah, that's what he goes on. Do I pay the extra and then just file an amended return when okay, that makes sense. Okay, we got a question that just came in by email. Where do you sign up for consultation, and what do they get with their consultation? So if they signed up with a tax hive consultation, my understanding is that you'll get, if they go to the protectwealth.com/tax hive, they get a free blueprint. What is that?
So blueprint just goes over your particular business and possible deductions that you could take based on different strategies that that we've kind of put forth within this blueprint, seeing which ones you do, which ones you aren't doing, what may benefit you. And it's a pretty good exercise to do, even if you stay with who you're at. Just to give yourself some ideas. And then the consultation is based on the information that you provide in the blueprint. Again, going back to the best conversations are the conversations where I know or have an idea of what it is that you're doing, because then you can talk about kind of more specifics into your particular situation. Don't have to talk as much in generalities.
And I saw your ad from Kevin O'Leary saying that if they can't find at least $10,000 in missed deductions, they're going to pay you $100.
Yeah, that's true.
I like that.
I don't want to pay $100, so I didn't bring it up. No, I'm just kidding. But yeah, that is true because they're pretty confident that we'll be able to find some stuff for you. Yeah.
So, for heaven's sakes, I look, if I had a doctor that gave me maybe advice that I didn't really want to hear, I think I might go get a second opinion. But so many people trust their tax professionals, I think, way too much. And I like the idea of getting a second opinion and keeping your CPA honest. Otherwise, you don't know if your CPA is costing you money or not, do you?
No, unfortunately, that's the reality of it. You don't.
So
after the fact.
So that what we're offering, we've kind of partnered with Tax Hive to put together this deal with you. If you'll go to that, answer the 6 or 8 or 10 questions, whatever it is, and be honest with it. And they can't give you tax advice if you're fluffing the numbers. Be honest with the numbers. But if they can't find you at least $10,000 of missed deductions, they'll pay you $100. I figured that's a pretty good deal. So, all right. Valerie, regarding Qubit, I have several companies. Do I get 20% per company?
So it gets accumulated within your tax return. So let's say I had 20,000 from this company, 30,000 from this one, 50,000 from that one, right? They'll all total up. Right. And then it gives you 20% of that number.
And does that max out at any point right now?
It maxes out to the extent based on your income.
Okay.
Right. So there are, if you make, with most things when it comes to the IRS, if you make too much money, they don't want to give you the deduction. Then it gets based on other things. Yeah. So you could fly through the threshold, but if I'm making a couple $100,000, even 300 grand, and I'm married, filing joint, I could get a nice big fat deduction on my tax return.
On all of your companies?
On all the self-employment income, yeah.
Correct. Okay. Laughlin, if I have a business with a profit and another pass through with a loss, do they need to be netted before calculating the Qubit?
So it does need to be netted, but it will depend on how those losses are coming over. Like if it's an LLC versus an S Corp, right? Those aren't necessarily the same type of income. So if I'm an active person in an LLC, that comes over. If I have a loss from a S Corp, that one comes over. So they're not necessarily going to just net themselves out. So it depends on the type of income you're getting.
Whether it's passive or active.
Whether it's passive or active, right. So the active ones will net out, but the passive ones, kind of sit on their own island.
Okay, good. What do you mean by S Corp that is only able to deduct certain?
Okay, so
taxes?
probably what he's referring to is, so when people set up S Corps, the income that they receive from an S Corp is what we call passive. And passive income is fantastic because it doesn't pay or doesn't have additional taxes on it, like Social Security, like self-employment tax, Medicare, those types of things. In order to qualify for the Qubit, as I said, the IRS loves to use words. They use that active determination. So from an active standpoint, what was it that I can apply those Social Security amounts to? So when you have an S Corp, it's really going to be based on wages when it comes to the Qubit. So if I made 100 grand on my S Corp and I had $50,000 of wages, my Qubit is going to be based off that 50, not that 100. So it's a little different than how it works with like an LLC 1065 or a partnership.
So let me break it down just a little different. Let's say you make out of your S corporation $100,000.
Yeah.
You take a normal salary, let's say of $1,000 a week.
Okay.
So that's $52,000.
Yep.
The Qubit tax isn't going to be based on what you took as a salary, only the $48,000. Is that correct?
Other way around. So it's going to be based on the salary figure, not
all right.
remaining income.
All right. And then the 48,000 that's remaining, I don't have to pay self-employment taxes if
Correct.
That's coming to me as a dividend. So I'm getting an additional 15.3% off the
Savings.
48,
Correct.
but the cubit would apply to the wages that I took
Correct.
out because of the owner.
Yeah.
All right. I hope
I know it gets
that
kind of, this whole thing gets a little complicated. That's why, it helps if you just know, hey, there's a possible 20%. Let me have my tax guy deal with it.
There we go. Okay. Blanca, home office is good to take, or is it better to take it and just take the depreciation of the home?
So, okay. So anytime we have a depreciable asset and we sell that asset, we have to look at whether or not we have gain and whether or not there's recapture of the depreciation we had taken. So like for a rental property, or when it comes to my house and the home office, if I'm depreciating my house and the home office, eventually when I sell that home, that depreciation gets recaptured and I'm going to owe some tax on it. So that's the back end trap to the traditional home office method. That's why I'm a big fan of the simplified method up to that $1,500. It's an easy deduction. It's just based on square footage. If I own my house, I don't have to worry about recapture of anything. It's my personal preference, but everyone has their own.
Okay, so let's say I've lived in a house and I've deducted the whole third floor. The kids have moved out. So it's legitimate. This is my wife's office, my office. There's a little bathroom. The only reason we go upstairs is for business. Okay, so we're deducting a third of the house. And so we continue to do that for several years. We're eligible for a $500,000 capital gain exclusion.
Correct.
Am I ever going to have to recapture that
depreciation,
home office depreciation?
Well, you will, because that's the portion that's going to be taxable off the sale.
Okay,
So
good.
Yeah. So you have to be willing to do that. Like if you're going to, I'm never moving, I'm dying here. I'm like, fantastic. Then take the traditional home office. It's awesome. You'll pass away and your kids will get a step up in basis and they inherit the property. Great. But a lot of people are more mobile than that nowadays. We tend to not be in one place for as long, and we're moving around all the time. So, that's why I kind of like that strategy.
Cool. All right. H, whoever H is, can prescribed medication not covered by health insurance be deducted as a medical deduction under a C corporation?
Under a C corporation?
Yes. So if I've got a C corporation,
anything to qualify for a medical deduction has to be a prescription, not over-the-counter medications.
Yeah, if it's prescribed,
it's prescribed.
Anything under section 105 medical.
So even if I do a 105 medical reimbursement plan, it still wouldn't be like supplements and so forth. We're still looking at the same types of, it still has to qualify the same way. So I'm still looking at something that's prescribed.
Correct. Okay.
Now, so the trick there is, what do? Why not go get a prescription for whatever it is that you think you need for your doctor? Keep it on hand.
Correct.
Right? Yeah.
Yep. So get a prescription for your Advil and your Bear aspirin, and then you can deduct it. Exactly. Okay. He goes on and says, can I charge it under the C Corporation business credit card if I have a medical reimbursement plan? Let me answer that. No, it's a medical reimbursement plan. It should be paid for out of the corporation. It should be paid for personally and then reimbursed. That's what it's called, is a medical reimbursement plan. But don't try to pay for your vitamins and herbs and supplements and everything unless they're prescribed. Pay for them personally. And what I'll do is I simply invoice the corporation. You can do it weekly or monthly or yearly, or I don't care. Just do it on a regular basis. And then the other thing is, with a 105 medical plan, you have to have that language in your corporate notes. It has to be in your resolutions and your bylaws. It has to be in your corporate document somewhere. I've seen several times where people have a C corporation, they're deducting medical, but it was never in the bylaws. and it's overturned. Joel, what's been your experience with medical reimbursement plans?
Yeah, you have to be very strict on keeping all those receipts and records from a reimbursement standpoint. Really, like I said before, when it comes to documentation under IRS scrutiny, really it's the receipts that help us. And I've had someone who actually got audited, and they looked at their reimbursement plan, and they, within their plan, they had a limit to how much the company, it was an older plan, would pay, and they were trying to deduct more, and the IRS kind of held their head on the plan and then disallowed a bunch of things. So really, it's about documentation, having a plan in place that allows you to meet the requirement in order to reimburse yourself those costs.
And then follow the plan that's in your
follow the plan. And guess what? If the plan needs updating, update the plan.
Yeah. All right. Walter, one of our friends is really bugging another friend of ours, a big time tax attorney, about during a round of golf. He sent the questionnaire a bill. They still played over the years, but no more tax questions. I'm not sure what you're asking.
I don't know if he's meaning that he's trying to deduct a round of golf, but the current code went away with all those entertainment expenses.
Yeah, that's
something that's an older scenario than what's currently allowed. But
can't deduct. Yeah, can't deduct entertainment.
Yeah.
Okay, can you explain self-directed IRAs and how to get one?
So any licensed financial advisor, for example, could help you with that. TD Ameritrade, banks, Fidelity, for example. Fidelity is an easy one to use. You can just contact them directly and kind of set that up. They have paperwork that you just download and mail in. It's actually pretty simple. But the reason I would suggest talking to at least an advisory, even if you paid for a quick meeting, is to understand the various options that you have, because there's more than just like a solo 401k. You have, simples and all these different investment strategies that you can utilize, and to pick the plan that's best for you under your income kind of constraints, or however much it is that you're making. But the setup is not actually hard. If you're going to do it for 2021, I would definitely do it before the end of November, or the fiscal corporation or the fiscal provider may not have enough time to process your paperwork.
And the other thing I would add to that is find out what it is you want to invest in. There are custodians that really specialize in precious metals. There's custodians that specialize in real estate. There's custodians that specialize in stocks and bonds. Pick the investment strategy that you want, and then go after a custodian that specializes in that. Because if you call TD Ameritrade and you say, can I invest in real estate? They're going to tell you flat out no. And it's not that you can't do it. What they're saying is, we don't do real estate, and they'll tell you it's a prohibited transaction, and they'll tell you that it's dangerous, and they'll tell you everything to try. I'm not picking on TD Ameritrade. I guess I did. Sorry, I didn't mean to do that, but that wasn't the goal. Pick the strategy before you pick the custodian, and then if you don't care, your bank or credit union will set up a self-directed IRA, and in fact, all IRAs are self-directed to some degree, because you get to depict the whatever you're investing. Anyway, Joel, any other thoughts?
Yeah, and I would ask them about crypto. Crypto is on a lot of people's minds, but not all custodians allow for crypto investing. So if you're a big crypto person, Bitcoin crossed 50,000 this morning. Yay. I would ask them about that.
Good. Can I get a tax deduction on gym equipment?
No. Do you like that answer?
What if I
the only way you'd have to get something prescribed from your doctor again, that you
Correct.
Are required based on your health circumstances and this piece of equipment, like any other medical equipment, because really gym equipment could be construed as a medical device, depending on who you are and what your particular kind of health issues may be. But for any of that type of stuff, you'd have to have a medical doctor prescribe it and have that on hand.
And then if you live within a half mile of a gym or 2 miles of a gym, and it costs, $10 a month for a gym membership, may be denied, going, well, it's not practical or reasonable. So it has to, it depends.
Yeah.
All right, Brian, again, we have a son who started college this year. Notice on your list to prepay college. How is college tuition, books, etc., allowed to be deducted from your taxes?
So it's not necessarily deducted. What it can produce is a tax credit. Again, these things are all income dependent, and I don't know your particular situation, but you can get up to $2,500 paid based on how much your tuition that you paid was, and books that are required by a particular class that you had to pay for, and allow you to maximize that deduction. And it depends, some community colleges, for example, depending on where you are, may not be that expensive. And maybe they're only costing you a couple $1,000s a year. So if you've paid for half of the year up front and you're going to pay for winter and spring coming around the corner, and you say, I want to try to maximize my deductions, maximize my tax credit when it comes to the education, well, prepay it during this year. So you can try to maximize what your credit is this year. So if you can get up to that $2,500 level and have $2,500 worth of your taxes paid. So that's what I was referring to when it came to that, is trying to maximize that credit.
Good. Thank you. Nick, can I refund myself, or can I fund my self-directed backdoor solo 401k with money received from the sale of personal goodwill?
So
he gives a little more information.
Well,
Recently sold.
I'm not exactly sure how that's being done, but I'll say it this way. Goodwill, I don't even know if you could sell goodwill. So I'm just gonna say that let's work under the premise that you can sell personal goodwill. Okay. Personal goodwill would be a non-active type of investment, or an investment dollar that's producing non-active or passive income. And I need active income in order to contribute to my retirement plan. Passive income does not allow for those large contributions.
Okay, he goes on, he says, recently I sold a pest control routes out of my S corporation. I want to fund my 401k. I'm the only employee, and for health reasons can no longer work in pest control business. I now have a real estate flipping business. PS did not sell the bug business, just one route. Okay.
So if you sold one route, I'd have to go back and look to see, whether or not that's producing, how those routes are accounted for within your business, whether they're passive or active. But just from a global standpoint, to contribute to a retirement plans, just remember I need active income. So just even income from an S corp doesn't produce active income to put into a retirement plan. Your wages would. So if you can pay yourself enough wage, then you can start taking some of that passive money and then contributing that to your retirement plan. So it depends on that kind of mix, and I would just keep that active income retirement plan contribution.
Great. All right, we've got just a few more minutes. I'm going to go through these a little bit faster. I have W-2 employment and a rental property that I brought in March this year. What are the best deductions I could have? So W-2 employee and also rental property.
So rental properties are great. They often produce passive losses simply because of depreciation, interest, and how, that they kick off. So I would just make sure that you were maximizing everything that went into that rental property beyond maybe the obvious, being taxes, insurance, interest, looking at commissions, looking at repairs, making sure you're tracking your mileage, looking at internet tower people that are renting that, contacting you. So you may have to start running off cell phones and those types of things. So I would look beyond the simple basic deductions that you're aware of to a more broader aspect of what it takes for you to operate that particular real estate business.
And if we have a loss in that real estate business, that can go to What 3,000 up to $3,000 in investment income could wipe out W-2.
So it could go up to a $25,000 loss, actually.
Okay.
And so, but it depends on how much, again, income dependent, how much money you make out of your W-2 to whether or not you can take it or whether or not it's pushed forward. So if you make 100 grand in your W-2 and you have a $25,000 loss in your rental real estate, you get that whole loss.
Okay, good. How do I account for my new home office setup in a newly purchased home? I like furniture, mowers.
Great question. So when it comes to your home office, I would separate the home office from the furniture and assets that are inside the home office. Okay, the home office deduction is for the actual space, but your desk, furniture, equipment, all those are attached to the business. So you don't include them. So you deduct the furniture, the assets inside your company, and then you look at the space from a home office deduction. Did that answer the question? I don't know.
I think so. Yeah, very, very much. I don't have W-2 income, but my income is from stock investments and dividends in my personal name. How can I treat that as a business?
Ooh, investments. Investments are rough. You have to get to a trader status, and trader status is very difficult, and the IRS hates it, just so you know. So really, if you have investment income, I'd actually just think of and trying to start something on the side that's not related to my investments.
What if I started my own little Charles Schwab?
That takes licenses. If I'm receiving money to manage on other people, that's an active business. But it does require certain licenses and different thresholds that you have to go through to operate that type of business. So I would probably look at if all you're dealing with investments, maybe talk to someone about trader status. It's not the easiest thing to get, but that does allow for additional deductions.
Okay. Are grants taxable?
Yes.
Okay. I'm an insurance agent. If I set up an S corporation, my husband is one of my employees and licensed. Can we deduct his golfing? No.
Only if you take me.
Yeah, they took away entertainment they took it off the table for businesses. There's not a lot of workarounds for the entertainment thing.
No, there's not.
Yeah. Okay. Well, thank you, Joel. I appreciate how well you pointed out that we have to consider taxes when measuring income and recognize that business expenses are virtually subsidized by the tax benefit from their deductibility, but it doesn't make them free. Thank you.
It
very
doesn't
good.
make it free. You're very welcome.
All right. I have a vehicle.
It's an interesting point because it doesn't make them free. And you got to think that whenever you go pay something for a tax deduction, it takes the whole dollar. But if I keep that dollar to spend personally, I'm only paying a fraction of that dollar from a tax perspective. So you have to weigh, what do I need to spend on the business? And what should I take home? And I'd rather pay the tax on it. Foolish spending sometimes can be worse than paying the tax. So just FYI.
I learned that a long time ago. I went to my dad who had a business and I was, I don't know, a marching band or something, and was trying to gain money and says, well, but Dad, your donation is tax deductible. He says, well, there's different. And he taught me the difference between this is tax deductible. It's not a tax credit. It just means that I didn't make that dollar.
That's right.
Very different. Okay. Brian, from an S corporation, is the qubit a personal tax deduction or a corporate tax deduction, K1?
So it is taken on your personal tax return, but it's based on the activity inside the business. It's a funky thing. I don't like how they did it, but they tried to make it so if you made too much money, you couldn't take it. That's why they didn't put it inside the business. But it's basically, you can look at it in terms of it's a personal deduction based on the operations of the business.
Okay. Somebody's saying I will be receiving a major investment in the amount of millions of dollars. I've never paid taxes in 40 years. What do I do now?
You should run to a good CPA and start tax planning immediately.
I think so too.
Yeah.
Good. I like simple. That's good. Okay. I have a home business, and you know what? We may have to leave some of these questions. Please, if you haven't signed up for that little free blueprint, just fill out the thing. And let somebody from Tax Hive take a look at your taxes, get a second opinion. This is like a no-brainer kind of thing we put together. I've known the principals at Tax Hive for, oh my gosh, like 20 years. And I know them to be good people. Let them take a look at your taxes and see if they can save you money. Are they in business to do your taxes? Yes. Do they do good bookkeeping? Yes. I think that's your principal businesses, isn't it? Isn't tax and business?
Yeah, tax. Mm-hmm.
Tax. Okay. Yeah. So anyway, take a look at that. If you have a stimulus check or had a stimulus deposit to your bank account to which you were not entitled, does it have to be returned? If so, how is that done?
So usually that process is actually done through your tax return.
Okay, good. If I have cryptocurrency sold and the exchange don't provide a 1099 form, so what do I do in this case? Do I have to declare it myself?
So yes, essentially. Yep. So even if they don't provide you with the 1099, that doesn't relieve us the obligation of inserting that into our tax return. We're required by law to report all income earned.
Right. And the obligation is not on us, although it is on businesses to give you 1099s and W-2s and K-1s. But
it is, but not all of them do it, right? Tons of businesses just forget, overlook it, whatever the case may be, but that doesn't relieve us from needing to report it.
Correct.
Yeah.
Okay, Debbie is saying, can those medical expenses be deducted from an LLC? And the answer is only C corporations and LLCs taxed as C corporations have the advantage of choosing a 105 medical reimbursement plan. S corporations, entities taxed as partnerships, sole proprietorships do not. It's isolated to the C corporation as far as I understand it. Is that
Yeah.
right?
So what I would do is I would go through, I would sit down with there are lots of companies that provide these type of plans for you. And I would the easiest thing to do is just sit down with one of them, go through your scenario, and then let them give you what options. And these things are not typically very expensive to set up.
And the C corporation may not be for everyone,
Right.
but maybe a little HSA plan. I can deduct most everything.
Yeah.
And, and so look at it's kind of an individual tax situation, but I think Tax Hive could give you some good advice on that. All right. Are there other ways to have a pass-through income from C Corps other than dividends?
No, not really.
Yep.
Not from a passive standpoint, right? Where it's not like a wage. So if I own a C Corp, I need to be paid a wage for whatever it is that I contribute to the C Corp. And then after the C Corp pay taxes, it can pay me dividends. And if those dividends are qualified dividends, then I'm dealing with long-term capital gain rates, which is obviously lower than income tax rates in most cases, not all, but most cases. But yeah, that's basically those are the two ways to get money out of it.
Okay, does qualified business income apply to C corporations?
Nope, C Corps are on an island unto themselves.
Yep. All right. My son is planning to attend business grad school. Can I help with this tuition and expenses, be able to deduct some on my taxes? Is there a way? I think you answered that.
Who's that from?
Lyman.
Lyman. Okay. Let's just say you can be a phenomenal parent and help the education of your child, right? Because you want them to succeed. But if they are not a dependent, you don't get the deduction.
Now, if they're contributing something to your business, you could be paying them they're a
So
full-time
it
student.
depends on how you look at it. You could pay them income deducted on yours. They would then include the income on your child's tax return. But depending on how much it was, then they would apply for the tax credit based on their educational costs and try to reduce any tax that they would owe based on that money. So you can try to do it roundabout ways like that. But just from a strict educational credit standpoint, they need to be a dependent or you can't have it.
Great. Okay. So many more questions that we haven't got to. What should be the best business structure for my rental property so that I could do a retirement contribution?
Ooh, you want me to get into that? So the best thing to do is to have an LLC, first of all, that houses the rental property. The easiest from a tax perspective to get properties in and out without creating taxable events. You can also form a management company that your real estate property would pay to manage the company, thereby producing active income from passive income. And from the income you make on that end, you could contribute to your retirement plan. So it's kind of a two-stage deal to kind of make it active and get that money into your retirement plan. But it's something that can work, and I have lots of clients to do it.
Great. Yes, that's exactly what we would do as well, is we would set up a management company and take a wage. Yes, you're gonna get dinged on self-employment taxes, but now I have earned income and now I can contribute to a retirement plan.
Right.
Okay. Can you talk about the employee retention tax credit?
Ooh,
This is
like that. So that kind of that falls along the lines. You don't do it through your income tax return. You do it through your 940, 941 filings. You have to you're looking at that 25% reduction in gross wages. I'm sorry, not wages, gross revenue, right? Gross sales, the top line figure between 19 and 20. If it went down, it does go, well, I've seen some changes on that. It was going through the end of the year, but I'd have to look to see if they ended up capping that in October, but it does qualify in 2021 based on the retention of those employees. But that's not something that goes through your income tax return. So if you're dealing with payroll or have a payroll provider that's doing that for you, that's who I would contact to kind of go through that scenario.
And we will be covering that at the 3-day summit coming up next week.
Great.
Yep. So, okay. Can one company have both a 401k and a 401a?
Good question. I don't know if I know exactly the answer to that. I haven't looked that up. That might be the first time I've been stumped on a question if they can have both. I don't know
that one either.
Yeah, I will say this, that even if you had, let's say for our conversation that it was allowed, okay, that doesn't change your contribution limits, right? So that's not like, oh, I can double up or triple up, based on the number of retirement plans. You can't do that. So because our ability to contribute into retirement plans is based on the income that we make when we're self-employed, for example. So those limits are still there, regardless of the whatever types that I'm using. But that's a great question. I wouldn't know the answer to that. I'm not going to try to give you an answer that I'm not confident in.
Okay, we have skipped over some questions, and I apologize if we have. They're coming at me fast, and there's only one. and I know that I've missed some. I apologize. Joel, you've been wonderful at taking extra time, and I know it's late, especially on the East Coast. We appreciate all of you that have stayed with us this long, and Joel, especially your time.
Yeah, no,
right in the middle of tax season.
Yeah, back to taxes. I still got another couple hours in me. My caffeine's not out.
So again, I would encourage anyone on the call to take advantage of this free blueprint by Tax Hive. Let them take a look at your taxes. It's simple 8 or 9 questions. Be honest, be truthful with that, and then let them take a look at your taxes. Give you a blueprint. Sit down and strategize. And if they can't save you $10,000, or no, I said that wrong. If they can't find at least $10,000 worth of missed deductions, it's a free $100 to you for your time and trouble. It's a fair deal. And Joel, you guys do a lot of those blueprints, I bet, don't you?
Yeah, we do.
So take advantage of that. Any closing remarks before we
No,
call it a night?
I just want to wish everyone, the most success possible. Take to heart maybe some of the things that may have resonated with you that we talked about this evening, put them into place. Make sure you're always trying to maximize the income that you're making and your tax savings based on your tax planning. So just the best of success, and I wish everyone a healthy rest of the year.
Thank you, Joel. And my takeaway from all this is that your tax preparer is only as good as the information you give them.
Yeah.
So with that, thank you everyone for being on the call. Have a great night. Joel, especially, thank you.
You're welcome. Night, everyone.
Good night.